Taxes are the biggest cost to an agency after team, and it amazes me how many thousands of agencies are overpaying on their corporation tax. Not because they're doing anything wrong, but simply because they're not claiming all of the reliefs and allowances that are available to them, and they're not doing basic tax planning. So in this video, I'm going to show you the top 5 reasons an agency ends up overpaying on their corporation tax bill, and more importantly, what you can do about it. Stick with me, because if you run a limited company, this can save you thousands of pounds every single year. My name is Rayhan Mogul. I'm the founder of Sidekick Accounting, and we specialize in helping agency owners make more money and pay less tax. Now, going into 2026, corporation tax remains very complicated in the UK. The main rate is 25%, but not everyone pays 25%. There's also a marginal relief available for businesses that are earning under a certain amount of profit. That would mean they pay an effective rate somewhere between 19% and 25%. This added complexity means that if you're not planning for your tax bill, you are overpaying in 2 areas. Firstly, on the actual amount of profit that you pay tax on. By simply not claiming deductions and reliefs, that number is going to be bigger that the percentage is applied to. And secondly, by pushing yourself into a higher rate of tax than you maybe need to be. So tax planning under the current system can have a huge impact on the amount of cash that is left in your bank. Now, the key thing to remember here is we're talking about planning. If you've passed your company year end, there's very little you can do. However, if your company year end is some point in the future, there is a lot you can do and you should be doing to minimize the amount of corporation tax you pay. Now, here are the top 5 biggest mistakes I see businesses make that cause them to overpay on corporation tax, and what you can do about them in 2026. First, the biggest mistake is simply not using the reliefs and allowances that are available. If your company is spending money on equipment, mobile phones, laptops, even company cars, you can deduct the value of these purchases from your profits through something called a capital allowance. Within capital allowances, you have an annual investment allowance, which is currently £1 million. That means qualifying purchases within the year up to £1 million can come straight off your bottom line. A big mistake people are making here is they're either not claiming capital allowances at all, or they're claiming the wrong capital allowance. Capital allowances have nuances. Some qualifying assets will allow you to take 100% of the value off in year 1, while others will only let you take a smaller percentage off your profits every year. For example, if you're buying an iPhone for £1,500, that can qualify for a capital allowance, which means the £1,500 you've spent on that asset comes off your business profits for tax purposes, saving you your tax at your applicable rate. So if you're paying corporation tax at 25%, that iPhone is not costing you £1,500, it's costing you £1,125. And then there's R&D relief. Even with recent changes that have made them stricter and slightly less valuable to a business, they are still massively valuable from a tax point of view. If you're building new software, creating digital platforms, doing something that pushes the boundary of technology within your space, it may qualify for R&D relief. I've seen companies get tax refunds of 6 and 7 figures back into their bank account for stuff that they were already going to spend the money on anyway. A great example of this is we recently did a claim for a client who invested last year in developing a platform to link influencers with agencies. This was something new in the space. They demonstrated how it was pushing the technological boundaries of what's been done, and they ended up with a refund of £50,234 back into their bank account. And that's just for year 1 of development. The second mistake is how directors are taking money out of their company. You have 3 main options. The first is salary, the second is dividends, and the third is a director's loan. If you're not using the combination of the 3 with a strategy in place, the chances are you're overpaying on company tax and personal tax. Next, let's talk about salary and dividends. A lot of directors are simply taking dividends out. They're not running payroll. What this means is that all of their extractions are from profits after tax, so any dividends are not reducing their taxable profit. Like we said at the start, this means that your taxable profit is higher. You're applying a percentage to a bigger number. But secondly, the percentage that you're paying can also be higher because you're declaring higher profits. So what you want to do is a combination of salary and dividends, because salary can come off your profits before tax. So by splitting the money you take out of the business between salary and dividends, you're saving corporation tax, and you're also going to save some personal tax. Now, the third one was a director's loan account. This is all completely fine until you get to 9 months and 1 day after the end of your financial year. If at this point in time, you still owe the company money, there's a tax called Section 455. This tax is payable by the company on the overdrawn loan amount at 33.75%. That's money that you need to pay to HMRC that you can reclaim when you show that that loan has been repaid. This is in place for anti-avoidance, so you can't take a loan over the long term instead of declaring a dividend. The third mistake is missing business expenses, not claiming everything that you can. A lot of people underestimate how much they can actually put through their company. HMRC have a rule, which is anything that is wholly and exclusively for business purposes can go through the company. That means home office expenses, training, travel costs, subscriptions can all go through the company, and if you're paying for it on a personal card, you're throwing away money. I once reviewed an agency owner's personal bank statement at the end of their year. We found over £8,000 of money that was spent on the personal card that was able to go through the company as a business expense. That's more than £2,000 of tax saved simply from paying for the right things on the right card. The key thing to remember is if it's wholly and exclusively for business purposes, it's probably a business expense. The fourth mistake is all about timing. Corporation tax is calculated as at your year end, which means the timing of income and expenditure can have a huge impact on the amount of tax you pay. Say your year end is the 31st of March. You had a couple of new joiners starting in April and you need to buy them laptops anyway. You may choose to buy those laptops in March so you can take the deduction in the current year. If you purchase them in April, you would still get your deduction, but you'd have to wait another year before you see it materialize. And on the income side, while the work that you do has to be invoiced in the period that you're doing the work, say you won a new client or you have a project that's kicking off, you may choose to delay the start of that project to after year end to push the income into the following year. That small shift may mean that you effectively are paying a lower rate of tax this year. This type of planning is something very few business owners actually do. But if you do take the time to do it, you can have a huge impact on your cash flow and your tax bill for the next year. Number 5 is structure. A lot of agencies are set up in a way that doesn't match their growth ambitions or doesn't even match where they are today. Some stick as sole traders when they would be much better off through a limited company. Others have a ton of different things going on within one limited company where they'd massively benefit from a group structure with multiple companies. We recently helped a client split out their software business from their agency, which was all in one company, into a group structure where there's 2 separate companies, there's a holding company, and they have a tax plan for the future, which will save them over 6 figures in the next 5 years. So those are the top 5 mistakes and what you can do about them in 2026 to reduce your corporation tax bill. If you do just these 5 things, you'll be ahead of 99% of other businesses. Finally, if your accountant isn't saving you money, they are costing you money. And if you want to save some money in 2026, use the link in the bio to book a call with me or the team, and we can talk about your goals and how we can help you pay less tax. As always, if you found this video useful, give it a thumbs up and subscribe to my channel for more tax saving content.